Why does owning investment property seem so appealing to many Australians? One key reason is negative gearing. But what exactly is negative gearing and how does it impact the housing market? Today, we unravel the intricacies of negative gearing and its effects on Australia's housing market. Negative gearing is a tax policy that allows investors to deduct the costs of owning an investment property, such as mortgage interest, maintenance, and depreciation, from their taxable income. If these costs exceed the rental income, the investor incurs a loss, which can then be offset against other income, like wages or salary. This tax benefit makes owning investment properties financially attractive, even if they are not immediately profitable. Let's start by understanding the appeal of negative gearing for property investors. By allowing investors to claim a tax deduction on losses from their investment properties, negative gearing effectively reduces the amount of tax they pay. This can make property investment more lucrative, encouraging individuals to buy additional properties, with the expectation that their losses will be outweighed by future capital gains as property values increase. However, this tax policy has significant implications for the housing market, contributing to both its strengths and its challenges. Firstly, negative gearing has been a key driver of property speculation and investment. With the ability to offset rental losses against other income, investors are incentivized to purchase multiple properties, betting on the long-term appreciation of property values. This increased demand from investors drives up property prices, making it more difficult for first-time homebuyers to enter the market. The heightened demand for properties also exacerbates the supply-demand imbalance in the housing market. As more investors snap up available properties, there are fewer homes left for owner-occupiers. This competition pushes prices higher, further diminishing affordability for those looking to buy their first home. Moreover, negative gearing contributes to income and wealth inequality. Typically, higher-income individuals benefit the most from negative gearing, as they have more disposable income to invest in property and can take greater advantage of the tax deductions. This means that wealthier Australians are able to grow their property portfolios and accumulate more wealth, while low and middle-income earners struggle to afford a single home. This policy also affects the rental market. On one hand, it can increase the supply of rental properties as investors buy homes to rent out. On the other hand, if many investors are holding onto properties primarily for capital gains rather than rental income, they may not be motivated to keep rents affordable. Consequently, rental prices can still rise, placing additional pressure on renters. Negative gearing's impact on government revenue is another point of contention. The tax deductions claimed by investors represent a significant cost to the government, resulting in lost tax revenue that could otherwise be spent on public services or social programs. Some argue that this lost revenue could be better used to build affordable housing or provide housing assistance to those in need. To address these issues, some policymakers and economists have proposed reforms to negative gearing. One suggestion is to limit negative gearing to new properties only. This could encourage investment in new housing developments, increasing the overall supply of homes and potentially stabilizing prices. Another proposal is to phase out negative gearing altogether, reducing the tax advantages for property investors and leveling the playing field for first-time homebuyers. However, any changes to negative gearing are politically contentious. Proponents argue that reform is necessary to address housing affordability and reduce inequality. Opponents, particularly those with vested interests in property investment, contend that altering or abolishing negative gearing could disrupt the housing market, decrease property values, and reduce the incentive to invest in rental properties, potentially leading to a shortage of rental housing. To summarize, negative gearing is a tax policy with far-reaching implications for Australia's housing market. While it offers significant benefits to property investors, it also drives up property prices, exacerbates inequality, and impacts government revenue. As the debate continues, it is crucial to consider how best to balance the interests of investors, home buyers, and renters to create a more equitable and affordable housing market. Feel free to share your thoughts on negative gearing and its impact on the housing market in the comments section below. Do you think reforms are necessary, or should negative gearing remain as it is? Don't forget to subscribe to our channel for more insightful discussions on economic policies and their effects on society, and thanks for watching.